All right, we have a fascinating one for you today. It's all about FuelCell Energy's latest earnings report. Now get this, the company reported a massive loss, but the stock, it skyrocketed over 22% in a single day. So we're going to dig in and figure out exactly why the market saw gold where the headlines saw red ink.
This right here, after their earnings call, this was the number for FuelCell, a jump of nearly 23% in one day. And a ton of shares were changing hands. So the big question is, what on earth did investors see that made them just shrug off all the bad news?
And this is where it gets really interesting. It really captures the puzzle. On one hand, you have a staggering GAAP loss of almost $4 a share. Ouch. But on the other hand, the stock has this monster rally. Now, this wasn't some kind of glitch. It was a clear signal. The market was telling us it was laser-focused on a completely different story.
So to understand that signal, we've got to look past that ugly headline number and see what investors were actually paying attention to. Because in every earnings report, there's the black and white accounting, and then there's the story about the future that the market decides to believe in.
Okay, let's break down the actual results. Yeah, that GAAP number, it was a huge miss, for sure. But, and this is a big but, a lot of that was from a one-time restructuring charge. What Wall Street really cared about were these two highlighted numbers. The adjusted loss was 95 cents, way better than the $1.59 loss they were expecting. That's a big beat. And even better, revenue came in at almost $47 million, beating expectations there too. So the market just completely ignored the one-time hit and zeroed in on the fact that the actual operations, they were doing better than expected.
So, where did that revenue beat come from? Well, it was all about this one slice right here, product revenue. It shot up to $26 million. And that was almost entirely because they delivered 8 replacement fuel cell modules to a key customer over in South Korea. The key takeaway here is that this wasn't some accounting trick. This was real, tangible product going out the door.
But let's be real. A couple of nice beats on the numbers, that doesn't get you a 23% pop in your stock. No way. For that kind of move, you need something more. You need a powerful story. And on the earnings call, boy, did management deliver a story. They painted this incredibly compelling new vision for the company's future.
And this quote from the CEO, this is the heart of it all. They're aggressively changing the narrative. They're saying, hey, stop thinking of us as just another clean energy company. We are a crucial power provider for the AI revolution. I mean, with just one sentence, they completely reframe the entire investment case. You're no longer buying a struggling clean tech stock. You're buying a pick and shovel play on the AI boom.
And this wasn't just talk either. They laid out this super clear 4-step plan to get there. For any investor who was worried about the company's direction, this was like music to their ears. It's a logical roadmap. First, clean up the business and cut costs. Second, focus on your best technology. Third, in that tech right at the massive data center market. And fourth, prove it's all working with real partnerships. And here's the proof in the pudding. The deals with GGE and Exxon show the core business is still solid, but the real excitement, the stuff that lit a fire under the stock, came from the names tied to that AI story. They signed an MOU, which is basically a serious letter of intent, with a Korean company called Inuverse for a massive 100-megawatt data center project. You pair that with a new joint venture in the US, and suddenly that AI story doesn't feel like a distant dream anymore. It feels like it's happening right now.
Okay, so that's the bull case, and it's a really exciting one. But now we have to pump the brakes and ground this whole thing in reality. The market was euphoric for a day, yeah, but there are some pretty big risks here that you just can't ignore. This is the part of the story the bears are focused on.
And this chart just puts that one-day surge into really stark context. Let's zoom out and look at the past year. The broader clean energy sector was basically flat. Fuel cell stock down over 60%. So that incredible one-day pop, while it was impressive, was really just clawing back a tiny piece of a huge long-term loss. Underperformance is a major part of this stock story.
So it's absolutely critical to understand these risks. That big GAAP loss, it came from a very real $64 million write-down. The company is still burning through cash every single quarter. And to get more cash, what are they doing? They're selling more shares, which dilutes existing owners. But maybe the biggest challenge of all is that their whole plan to become profitable requires them to almost triple their production. That is a massive, massive execution risk.
So when you put it all together, you've got these operational beats and a really powerful AI story on one side, and you've got these very serious financial and execution risks on the other. So how do we balance those two? Well, here's our take. We're assigning a market perform rating. Why? Well, because the bull case and the bear case are both incredibly compelling and almost perfectly balanced. The AI data center opportunity is absolutely real, and it could totally transform the company. But the financial realities, the cash burn, the dilution, the huge challenge of scaling up, those risks are just as real. The stock could swing wildly in either direction depending on the very next piece of news.
Now, given that kind of high-wire act, it sets up a pretty interesting speculative idea. On earnings day, call option volume just exploded, surging over 400%. So what if you lean into that volatility? What's the outrageous but plausible trade here?
So the idea is to use long-dated call options. This lets you capture that massive upside potential if, say, FuelCell announces that big Korean deal is finalized, or they sign another data center partner. It's a way to bet on the story turning out right, while strictly capping your maximum loss. Of course, the risk is huge. If those catalysts don't happen and they just keep burning cash, that option could expire worthless, but it's a trade designed specifically to capture that asymmetry the market saw on earnings day, a small chance of a total game-changing win.
And as always, a quick reminder, this is not financial advice.